How much more can we get out of this? Is there more to go in this bull market?
Well, it's dangerous to make a big and bold call when the market's trading at all-time highs for sure. But from our perspective, we actually think there is much more to go in the years ahead. What we've been telling clients is watch out for some near-term volatility as U.S. markets in particular do look overheated or extended here. But on a long-term basis, and we're talking for the next several years, we still think the U.S. is involved in a massive reflationary secular expansion. And I think it's going to bring the multiple much, much higher in the years ahead. I mean, we're talking about millennials bringing new household and family formation in this country to new all-time highs within a decade. We're talking about 3 demographic cohorts now working, producing, consuming and investing side by side. That's baby boomer, Gen X, and millennial. That's generating a tremendous amount of money velocity. We think stocks are going to take an inflationary cue from all that money turnover. And within the next several years, we think the S&P is going well north of 3,500, probably closer to 4,000, believe it or not.
Wow. Totally, completely bullish. Joe Duran, you agree?
Well, over time, yes. I'm not sure it'll happen as quickly, perhaps, but over time, of course, if you own equities over any period of time, 10 years or longer, you'll be higher. And at some point, we'll hit 4,000 or 5,000. I'm just not sure it'll be as neat or as packaged in the next couple of years as maybe other
Why?
Other
what
folks.
worries you, Joe?
I'd say, well, I've a couple of things I would suggest. One, I don't love that the S&P, it's up about 7% so far this year. It's been driven 40% of it by 4 stocks. Amazon, Apple, Netflix, and Google, I believe, is the 4th one. So, you know, that's not great. It is great the Russell's at new highs, but I am a little concerned with the bear market we've seen in emerging markets. We don't know what the contagion effects will be. And again, I'm super bullish. I feel very good about stocks, but I'd suggest for investors who've been there from 600 to 2,400 that they look at rebalancing. Because again, I think your guest mentioned this, volatility surging is likely in the late stage. And the thing I'd say is the next stage of the market, you want to own different things than you probably owned on the way up, unless you're an index investor. So I think value stocks have really lagged for most of this time. They tend to be more defensive. I suspect we have a blow-off that comes in the next couple of months that will be amazingly good. And then you want to slowly be trickling into more value-based stocks so that if we do get a correction, you're well weathered. You also want to be rebalanced so you don't have too much in equities.
Okay.
We're at all-time highs. It means that you might be misbalanced.
There have been a lot of people who have been saying, basically, Joe, what you have been saying for quite some time, and that, i.e. that value is the place to go because it has not been the place to go. Dan, let me turn back to you and get you to react to that. You paint a very nice picture of an S&P or a market that is going to rise, but do you think it is going to rise in stair-step fashion, or could we hit some bumps along the way? And if so, how severe and how soon? In other words, is the market more likely to suffer a major correction now than, say, 6 months ago?
Yeah, I think, look, any secular bull market is going to have severe setbacks, even crashes from time to time. Even if you look at our cadence from the 2009 lows, we've had 20% corrections. In the 1982 to 2000 bull market, we had several corrections within there, a 1987 crash, an emerging markets crisis. So you're always going to take those temporary steps back. And I don't disagree with that. And I also don't disagree with the fact that we may need to see some rebalancing. We're seeing a lot of the momentum come out of the things that brought us here, those leaders like Joe spoke about. So we're actually seeing good breadth and participation, and we would encourage investors to start broadening out their exposure into things like transportation, industrials, healthcare, consumer discretionary, away from that tech-centric portfolio that has been leading. So I would agree. Over the short run, you can see some volatility. In any bull market, you can see some volatility. But the underlying secular drivers, valuation, demographics, credit cycle, simple supply demand, too much money right now chasing too few stocks out there. These are the things that I think are going to power us longer term. So I'm not looking for a neat package to 4,000, but I do think in the next several years we do get there. That's our belief.
Joe, I want to dig into this discussion around market leadership and the role that tech has played in that. I get that it's been a dominant force in the last couple of years, but I mean, just looking today at the 52-week highs, Best Buy, Advanced Auto Parts, Discovery, Darden, Nordstrom, Michael Kors, Costco, Hormel. I mean, it's broad. Should we be reading from the fact that you're seeing this broad rally, even if tech has been the outsized leader?
I think it's fantastic, and that should be what gives people peace of mind. What you'll see typically when you hit a new high is that new money coming in now has great FOMO, fear of missing out, and chases the things that have gone up the most. Remember, anyone investing now is probably less sophisticated than the people who were buying when the market went down. And so what you want to do is you'll typically see the things that ran continue to run even further. What I see also is a lot of folks now are index investing, and so it leads the whole, anyone in the S&P 500 is doing really well. We're seeing the Russell doing really well. So there's a lot of good things to see. What I would just suggest is you be prepared for a 15% correction in the next 6 to 9 months. Don't be surprised if it happens. Don't think that it's the end, but just be prepared for it so that if you've done well, you're protected. And if you haven't, you're prepared.
Now you can expect there to be some statistical reversion to the mean at some point. We just haven't seen in a long time. Gentlemen?
Again, it's been about 3.5 years. You know, it's a long, long time since we've had a 15% correction.